So let's be real. If you felt like the market in 2025 was a complete and utter mess, you were definitely not alone. And as we head deeper into 2026, it kind of feels like the chaos is only cranking up. The big question on everyone's mind is what's next? Are we looking at a massive rally, a painful crash, or maybe something else entirely?
Right now, it feels like we're watching a giant game of financial chicken. You've got the bears on one side, absolutely screaming that a recession is right around the corner. And on the other side, you've got the bulls just chanting AI stocks to the moon. It's this epic tug of war, and it's got everyone on edge.
And the reason for all this chaos is that the signals are completely crossed. It's weird. We're seeing some really positive signs like low unemployment, and people are still out there spending money. But at the same time, you can feel this tension, this fear of an asset bubble just waiting to pop. The economy is sending so many conflicting messages, nobody can seem to agree on what's actually happening.
So, here's what we're going to do. We're going to break it all down. First, we'll dive into the bear case, all the reasons to be cautious. Then, we'll flip the script and look at the bull case for optimism. And after that, we'll explore this really uncomfortable gray area that almost nobody's talking about. And then we'll wrap up so you can start to form your own view. Okay, let's start with the bears. What's got them so worried? Well, the elephant in the room is valuations. I mean, whether you're a full-blown AI believer or a total skeptic, it is really hard to look at some of these prices and not think things have gotten, well, a little ahead of themselves. Just look at these numbers for a second. NVIDIA is trading at around 47 times its earnings. Palantir, 400 times. Datadog is over 430 times. I mean, at these levels, you're not really investing based on today's fundamentals. You're basically, as one source put it, pre-ordering hope. And here's the thing. This isn't just an AI story. These high-flying stocks are dragging the entire market up with them. The S&P 500 as a whole is trading at nearly double its long-term average PE ratio. And if that valuation corrects back to normal, the whole market is going to feel that pain.
Another huge concern for the bears? The market is incredibly top-heavy. I mean, the whole point of an index like the S&P 500 is diversification, right? But look at this. Just 7 companies, what everyone's calling the Magnificent Seven, make up over a third of the entire index. That's a ton of concentration risk.
And here is the real kicker. Their impact on the market's performance is even more concentrated. In 2025, those 7 companies accounted for over half of the S&P 500's total returns. It's kind of like a group project where a couple of students do all the work, but the entire class gets an A. For now, anyway.
So how in the world did we get here? Well, a huge part of the story is the rise of passive investing. It creates this feedback loop. See, as these big tech stocks go up, they become a bigger piece of the index. Then all the new money flowing into index funds automatically buys more of those same stocks, which, you guessed it, pushes their prices even higher. It's a self-reinforcing cycle, but what happens when it breaks?
And finally, the bears will point to this classic financial concept, reversion to the mean. The idea is super simple. What goes way up must eventually slow down or come back down a bit. Historically, the S&P 500 has a 10% pullback about every 3 years. Corrections are just a normal part of the cycle, and statistically speaking, we're overdue.
Okay, so everything the bears are saying sounds pretty logical, right? But here's the critical pivot. Even if every single one of those points is 100% correct, it might not matter in the short term. As the famous economist John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent. Basically, being right too early is the same as being wrong, and that brings us to the bull case. All right, let's flip the script and look at the bull case. What if the market just shrugs off all those warnings and the party keeps going? Well, there are a couple of incredibly powerful forces that could make that happen. First up for the bulls, monetary policy. The Fed started cutting interest rates back in late 2025, and the market is expecting more cuts in 2026. Lower rates mean cheaper money for everyone, and that tends to push up asset prices. It's basically like giving the market a shot of adrenaline. But that's only half the story. While the Fed might be gently tapping the brakes, you've got the government with its foot slammed on the gas pedal. That's fiscal policy.
And the scale here is just massive. The U.S. government is running a deficit of over $1 trillion a year. Now, long-term, that's a whole other conversation. But in the short term, that is a fire hose of cash being sprayed directly into the economy, propping up demand and keeping the engine running really hot.
And this is where it gets really confusing, right?
You have these huge tailwinds from government policy colliding head-on with these massive risks like sky-high valuations. And when forces this big clash, the outcome is almost never a straight line up or a straight line down.
So, which one wins? Do we get a melt-up fueled by cheap money and government spending? Or do we get a crash triggered by those crazy valuations? That's the billion-dollar question.
But what if it's neither? There's a third option that really isn't getting a lot of airtime. Not a big boom, not a big bust, but a market that gets stuck in the middle. A long, choppy, sideways grind that goes nowhere fast.
Honestly, these sideways markets can be the absolute hardest for investors to navigate. Every little rally seems to stall out right when you start to feel confident. Every dip feels terrifying, but it never turns into one of those great buying opportunities. It's this frustrating grind where it feels like every single decision you make is the wrong one. And that's why they're so dangerous. They make people impatient. They encourage overtrading and emotional reactions, making impatience the ultimate portfolio killer.
So when the outlook is this cloudy, this messy, what are you supposed to do? Really, the best approach is to take a step back, consider all the angles we talked about, the compelling bear case, the powerful bull case, and that really messy middle, and start to form your own view of what seems most likely.
So I guess that's the crucial question to leave you with. After hearing all the arguments, where do you land on 2026? Are you feeling more bullish or more bearish? Or are you maybe preparing for that long, frustrating grind right down the middle? That's really the question to think about.